Hey everyone, welcome to your Algo Lab. In our last episodes, we backtested long-term moving average strategies. If you haven't seen them yet, we highly recommend checking them out. The links to the previous episodes are in the description below. Today, we're going to backtest a new strategy, the Resampled moving average, or ReMA for short. In episode 1, we analysed why long-term moving averages often have a low winning rate. One key reason is the number of false or losing signals. In a choppy market, prices fluctuate around the 200-day moving average, leading to false signals and losing trades. These small losing trades diminish the overall return. Is there a way to overcome this? We need a technique to identify signals with a high probability of being false, or to filter out false signals. One such technique is to use a confirmation method. We can, for example, implement a price confirmation where the price must cross the moving average plus a certain percentage. Alternatively, we can use a time confirmation where the price must stay above or below the moving average for a specified number of days to become valid. Here, we introduce a technique called resampling, which involves changing the frequency of time series data. To calculate our moving average and the corresponding signals, we resample our daily data to a monthly frequency. While other resampling frequencies are possible, we have chosen the monthly closing price because it is closely followed by the market, especially by many institutional investors. Here, we observe that instead of generating multiple false signals each time the stock index crosses the moving average, using a monthly resampled moving average limits the signal date to the end of the month. This dramatically reduces the number of false signals. Note that the resampled moving average is not the same as a moving average on a monthly chart. On a monthly chart, all intra-month behavior is lost, making it incomparable to a daily strategy. For example, the maximum drawdown cannot be directly compared between monthly and daily strategies. That's also the reason why most of the charting software cannot plot monthly indicators on a daily chart. Here at your Algo Lab, we'll code all the strategies and test them thoroughly. If you enjoy our content, please like, subscribe, and hit the bell icon to stay updated with our latest research. Without further ado, let's get started. Backtesting long-term signals can be challenging because traditional backtesting methodologies don't work well on long-term indicators due to the limited number of signals triggered. To overcome this, we look for commonalities across different markets, which helps guide us in selecting reliable indicators. In this episode, we'll be examining equity indices from around the globe. In later episodes, we'll explore other asset classes as well. From the United States, we have the S&P 500, the Nasdaq, and the small-cap Russell 2000. Moving to Canada, we have the TSX Composite. In Europe, our focus will be on the Euro Stoxx 50, the German DAX price index, the French CAC 40, Spain's IBEX 35, Italy's FTSE MIB, UK's FTSE 100, and the Swiss SMI. In Asia, we'll examine Japan's Nikkei 225, the Hong Kong Hang Seng Index, and Australia's ASX 200. We've collected data starting from 1980. For indices that began trading after this date, we've used the earliest available historical data. We've chosen price indices because reinvested dividends can distort the calculation of the long-term moving average. Let's set up our benchmark. Our benchmark will be a buy and hold strategy on equity price indices. Here are the benchmark buy and hold returns. For example, the benchmark buy and hold return on the S&P 500 was 9.00%. Just a quick reminder, this is the price return without including reinvested dividends. Returns are just one facet of an investment. We also need to consider risk. Our preferred measure for this is maximum drawdown, MDD. Maximum drawdown assesses the risk of an investment by representing the maximum observed loss from a peak to a trough in a portfolio before a new peak is achieved. In simpler terms, it shows the largest drop in the value of an investment from its highest point to its lowest point. For instance, the maximum drawdown in this example is minus 25%. Understanding maximum drawdown helps investors evaluate potential downside risk and determine appropriate position sizing. Here is our table of maximum drawdowns for the buy and hold strategy. For example, during the testing period, the S&P 500 experienced a maximum peak to trough loss of 56.78%. The Nasdaq saw a peak to trough loss of 82.90% during the dot-com bubble. Finally, we have our risk-adjusted measure, the maximum drawdown adjusted return. The MDD adjusted return is the ratio between the annualized return and the maximum drawdown. While it is not the only risk-adjusted measure, it is simple and effective. Now let's set up our test strategy, a long-only approach based on the resampled moving average. Here are the rules. Signals are only triggered at the end of each month. We'll buy the stock index if it closes above the 10-month moving average, calculated on a monthly basis. The entry price will be the next open price. We'll close the position if the index closes below the 10-month moving average at month end. The exit price will be the next open price. A commission of 0.2% is included in the calculation to account for trading costs. Let's incorporate the 10-month resampled moving average into the code to test its performance. Here's our table comparing the buy and hold benchmark with our 10-month resampled moving average strategy. We've highlighted the stats where the 10-month resampled moving outperformed the benchmark for clarity. For instance, with the S&P 500, the strategy didn't outperform the benchmark in terms of return, but did achieve a smaller maximum drawdown. Overall, while the average indices underperformed in returns, they effectively reduced the maximum drawdown. This makes sense because they avoided the most extreme periods of bear markets. So how do we account for both return and risk? We introduce a risk-adjusted measure, the maximum drawdown adjusted return. The MDD adjusted return is the ratio between the annualized return and the maximum drawdown. While it is not the only risk-adjusted measure, it is simple and effective. Here we see that the 10-month resampled moving average performed better in risk-adjusted return for most of the indices. This consistency is what we're looking for as we want an indicator to be effective across similar assets. Let's compare our 10-month resampled moving average strategy to our 200-day moving average strategy, which we back-tested and analysed in episodes 1 to 3. On the pros side, the 10-month strategy offers a slightly higher return, significantly fewer trades, and an impressive improvement in the win rate. This advantage comes from signal filtering using monthly resampled data. On the cons side, this strategy has a higher maximum drawdown. This results from the trade-off between signal filtering and signal timeliness. While we successfully filter out many false signals, we sacrifice the ability to respond quickly to both entry and exit points. So far, we are satisfied with the results of the 10-month resampled moving average, but we won't stop here. In the next episode, we'll conduct a simple grid search to see if we can further improve our 10-month resampled moving average strategy. If you like our channel, make sure to like, subscribe, and hit the bell icon to stay updated with our latest content. Thank you for watching, and see you next time.